After what we saw from Meta, Apple, Amazon, and Alphabet, does it change the ratings that you have for these companies or your view about the investability of mega-cap tech in the long term, or at least for the rest of this quarter?
Well, let's see. We thought we began the year with these assets being significantly de-risked, both in terms of multiples and estimates. Cost actions that kind of helped with that. And cost actions, that's a nice way of saying job cuts. And that seems to have largely played. Look, fundamentals across the group weakened. Revenue growth rates decelerated or turned negative for every single one of the big tech names. But that was finally estimated in, and that was finally priced in after a year of really aggressive estimates cuts, and after a year of multiples being brought down. It's just that the sector became more investable for the near term. For the long term, there's no change. But for the near term, the sector became more investable because the estimates had been cut enough and because the multiples had been brought down enough. And my guess is that the year-to-date gains we've seen in megatech are probably going to be sustainable.
So any ratings changes for you, Mark? Or are they all at the same rating they were before earnings?
I changed price targets around on some of these. I don't cover Apple. My top pick in this group has been Meta, not because Meta has better growth, but because its valuation was the cheapest. You can buy this thing at 14 times earnings, and they had taken aggressive steps in terms of reducing employees. But there was also the factor that they're actually now likely to grow their ad revenue faster than Google. That was kind of a surprise to the market, but just the setup seemed more reasonable to me, given the steps that they had taken and that the headwinds they faced, I don't think are as strong as Google has faced because they faced them last year. That was really the only change. At the margin, we became more constructive on Meta, but we continue to have an outperform on Meta, Google, and Amazon.
Yeah, Meta's really the talk of mega-cap tech right now. Alex, I'm going to come over to you. The year of efficiency, that really seemed to resonate with investors. What do you think about this year of efficiency when it comes to Meta, and what does that mean for broader tech that this resonated so much with investors?
Well, it's Mark Zuckerberg showing that he's the best CEO in big tech right now. It's speaking to the market and promising that he's going to deliver what they want, what the market wants. Now, Meta, it's not like it really slowed down its metaverse spending, right? The company still lost spent $4 billion on the metaverse, ended up spending somewhere around $12 billion for the year. So it's not like he's pulling back on spending all that much. Of course, there were the layoffs. But I think what the market really wanted to hear from Zuckerberg and all these CEOs is that they're listening. And that was the big fear. That's why Meta went down so much last year, is because Zuckerberg had this commitment to continue spending and to continue losing money without regard for what the market wanted. By saying this is going to be the year of efficiency, Mark Zuckerberg finally said, I'm paying attention to you. I know what you want, and I'm going to give it to you. And I think the rest of the big tech CEOs would do well to follow suit and say, message at least the same way, even if their business results aren't going to look exactly the same.
All right. One thing I want to touch on while we have you two gentlemen here right now, the NASDAQ down about 1% in the pre-market, a lot of fear that the Fed's going to do more tightening. What does Friday's jobs report mean for mega-cap tech and how investors view it? Blowout jobs report, job total probably about 3 to 4 times higher than what people were expecting. Mark, you.
Well, I don't think there's any doubt that one of the biggest headwinds facing mega-cap tech last year was the aggressively rising interest rates. I mean, we went through several years of super easy money and a decade of easy money. And so when you have rates go, I don't know, parabolic, I don't know what the right expression is, to go from 0 to expectations of 4.5% to 5%. I mean, that's a massive change. That change is not going to be nearly as massive going forwards, and the market is sort of waiting for the interest rates growth to moderate and then to come back down. And all of that will be that shift from aggressive growth in rates to moderating growth and to eventual, hopefully stabilization and then decline. That'll be kind of a fundamental positive for mega cap tech, but particularly for more what I call speculative tech, those companies that don't have material earnings until several years out. Those are the valuations that really got crushed. So I think mega cap tech gets less impacted by that, but it's not going to be the gale force headwind it was last year, but it will be a headwind until those rates moderate.
Alex, I want to ask you about the other side of the coin. Dell announcing today job cuts, becoming the latest tech company to do so. Shares down about 0.5% in the pre-market. We'll have to see if that changes. But generally, when these companies announce workforce reduction, job cuts, whatever you want to call them, they see a pop in the stock. Do you see that trend continuing when it comes to mega cap tech as well?
Yes, but more muted. And I think the reason is because we've gone through most of the pain for tech already. We're already seeing tech on the rebound now. And the conditions are starting to make sense for tech in the way that they wouldn't before. With the Fed tailing off on interest rates, now there's a little bit more predictability in the market, which is allowing the market to come back to these names. And the reason why we would see the pops on layoffs is because we were in this uncertain moment and we had no idea when inflation was going to tail off, when these rates were going to tail off, and the companies cutting people, cutting costs were a signal that, okay, we're going to be there with you as long as there's this uncertainty. Now that we're getting to more certain times, we're starting to see these stocks come back. And so the moves are not as meaningful as they were beforehand. That's probably what you're seeing with Dell today.